Have you ever wondered what type of life insurance is best for you? In this video series, we've been talking about that exactly. My name's Steve Larsen with Produce Freedom, and for years I've helped people create financial peace and allowing them to go after their passion and their purpose and to be able to give back to their communities and their families. And that's what I love to do. And we're going to continue on with this life insurance series. There are so many different types of life insurance products out there, different companies out there. We started by talking about the different companies, how they're owned, what risk they're involved in, whether they're covering like home and auto and casualty and all that type of stuff. We want to make sure that they have good ratings and different things. So then we talked about how to use term coverage, and then we talked about universal and indexed universal life, variable universal life. Today we're going to be talking about whole life insurance. So whole life insurance is a different animal than the other types of permanent insurance. When you're looking at universal life, you're looking at a product that's built on what's called a term chassis, meaning that the cost of insurance gets more expensive year after year. Now, how they underwrite whole life is different. They look at the whole thing all at once, and then you have a constant cost of insurance that doesn't increase. And so typically in a whole life insurance product, you'll have a mechanism that grows cash value with a guaranteed rate of return plus a dividend, and your death benefit and cash value will increase over time. And so if you've heard of things like infinite banking or bank on yourself or cash flow banking, this is the optimal product for something like that, as long as it's structured properly. This is what you would use for that type of mechanism. And so let's talk a little bit about whole life. Now, this is an example of a plain vanilla whole life insurance policy. This is not a bank on yourself or infinite banking type of policy. That uses different riders and different things to boost the cash value in early years. This is just saying, hey, we want to kind of compare this to our last videos of universal life and what it looks like. In our last video, the universal life for the same age range was $12,000 for $1 million in coverage. Now you notice that this one starts out higher, $16,000 a year for $1 million in coverage. Now, what you'll see though is that you'll start to grow cash value, and cash value will continue to grow. And it won't go back down like we saw in the universal life illustration, because this is underwritten on a constant insurance rate in the background, and so you don't have those increasing costs like you do in a universal life policy. Furthermore, you'll also see the death benefit increase over time. As you look through the years here, your death benefit actually goes up, and right here it says 1.6 million at age 70 and cash value of 825,000. Now this can be very powerful because this is built more on a contractual basis and allows more for fixed growth. So you've got the 4% guarantee plus dividends inside this policy. And because it's stable and you don't have that rising insurance cost, you can do a lot more things. You can do what's called a reduced paid up, meaning say, hey, I want to stop paying after year 20 and I want to trade in some of my death benefit for not paying, or we can have some of the annual dividend paid towards the death benefit, so it continues to grow, and I'll just pay the difference. You can take the cash value and turn it into a constant income stream for you in retirement. That's not taxable as long as it's structured right. You can also borrow against this. Say you're a real estate agent or you're some type of investor that you say, hey, I want to borrow money against the cash value of my policy and get kind of double arbitrage, then you can structure those. So whole life has a lot of living benefits amongst the death benefit as well. And so it can be a very powerful strategy. So when you want to consider whole life insurance, you want permanent insurance, we know that inflation is going to continue to go up, and so you want an increasing death benefit. You want to maximize your cash value growth by getting guarantees and dividends. And you don't want to have everything tied to the market. So if you have other investments that are already in the market, or in real estate or your own business or something like that, you want to say, hey, I want to have something else and diversify something completely out of the market, then this is more of a contractual growth using actuarial science. And I already talked about this, but this helps you create a tax advantage cash flow stream in retirement. So that the money that's grown and increased in value, you can utilize and not pay tax on it. And this is, like, just to reiterate, this is the type of policy that you would use to create a family banking system, right? Where you can create that double arbitrage, earning interest in the policy as well as whatever you're investing in at the same time. So it can be very powerful. These types of policies we write all the time. They're very helpful to business owners and people that want to have access to their cash while growing their wealth outside of Wall Street. So if you're confused about this whole thing, there are so many things. We just scratched the surface on talking about different policies: term, universal life, index universal life, variable universal life, whole life. It's like makes your head spin. We love talking about this stuff. It's only a part of our continuous cash flow method to make sure you have the right coverage for you and your family and to help you meet your goals. So if you're interested in going through this and figuring out what kind is best for you and your situation, then hop on our calendar and let us crunch the numbers and show you what we feel is best and the reason why, the advantages and disadvantages to each of these, and show you how this can make your financial plan that much more safe, secure, and stable. So thanks for joining with me here today, and look forward to seeing you soon. Bye-bye.